Welcome to Investor Talk. I'm Neil Peterson, and we bring you practical playbooks for South African property investors with no fluff. And today we cut through the noise where South African property market, where it is for investors, and in other words, what's actually bankable now, and the exact numbers, and we'll find out what it is we need to do to get a green light for a property deal. My guest is Carlo Mariani. He's the founder of The Property Coach, who has over 17 years of investing in real estate locally and also abroad. And he has 21 years as a business owner, and he's a straight shooter educator who teaches you how to fish and not to sell you property stock. Carlo, great to have you on the show.
Fantastic, Neil. It's absolutely great to be here with you and to share.
Wonderful. So let's get right into it, where we are in the South African property cycle right now. I mean, really honestly. So which cities or sub-markets are outperforming or lagging right now, and why is that?
Well, I think it's important that we keep a perspective on what is happening that is beyond what is happening today or what was happening last year or what's going to happen next year. Because most of us, as we invest in property, we invest for what that property, that area is going to look like in 10 years, in 20 years, or even beyond that, because time flies very fast, especially when you reach a certain age. So I think it's important that we look at what is the cycle of property, the short-term cycle of property, and what is the fundamental long-term story around it. And to a large extent, maybe apply 10-20% of our mental focus to the short-term cycle and 80% to the long-term mega trends. So going back, with that in mind, going back to the cycle, now it's always exceptionally difficult to know exactly where we are in the cycle, and there are certain indicators that could tell us that we are probably at the top or getting close to the top of this cycle. Now, the interest rates have come down quite a bit. Unlikely they're going to come down a lot in the near future. And we don't really have an economic growth cycle story underneath to impact on that significantly. Now, I think a short-term cycle is more important on the exit of a property investing rather than on the, call it, purchase of new properties. Because if you're exiting, the sentiment of the market is very important in terms of what you can realize in terms of the sale price. On the entry, I wouldn't wait to time the market. I would focus on what is going to be the right property in the right area at the right price. So with that call it consideration on the short-term cycle, if we go back to the long-term trends, I think there's a few important trends beyond the usual that are being mentioned all the time in terms of the growth of population, the urbanization. I think there's three elements that one should look at. The first one is income growth, and together with it is affordability. Now, if you look at the specifics, for example, the Western Cape market, where prices and rents have gone up significantly and well in excess of anywhere else in the country. Now, the question somebody should ask themselves is, how long can this last without a sustainable growth in income? Because at some stage, the affordability call it threshold or ceiling is going to come in. Definitely something to look at in my opinion. I think in the short-term cycle, the Western Cape market will continue to do very well. But because of that, doesn't mean that an investor should go in and buy anything anywhere. I think we've seen that the Western Cape market tends to be a bit more cyclical than, let's say, the rest of the country and Gauteng in particular. So we've seen that on the downside of the cycle, certain areas suffer a lot more. So if I can just get very practical and mention maybe a couple of areas, if you look at areas like Observatory or even the Cape Town CBD, on the downside, they suffer a lot more than areas like Sea Point or Greenpoint. So as we are on the upside and might be at the top of that market, one should play those considerations very, very carefully in mind. And another one for investors to really look into, because not a lot of people are talking about it. Everybody's talking about student accommodation and the fact that we've got millions and millions of students. But luckily or unfortunately, we are getting into a phase of our social demographic cycle where people are aging, and life expectation is going up very significantly. And these people, these elderly people, will need certain specific type of arrangements. And I'm not necessarily referring to retirement lifestyle centers or retirement villages. Most of them will not go to retirement villages, but they will still need a good, solid place to stay. As you know, I'm originally from Italy. I do spend quite a bit of time in Italy. And one thing that stands out when you go to Italy is how many elderly people there are. In actual fact, there's more people above 50 years old than people below 50 years old. So South Africa is not going to be there anytime soon. But savvy investors are looking into that. And again, for example, just to get it very practical, if you look at multi-generational living within the same, call it dwelling or the same earth, that is the kind of property that is doing really, really well, because maybe on the main dwelling, you'll have the family with the children, and maybe in the cottage or maybe in an extension of the property, you'll have one or two of the elderly. And that kind of demand is about to explode.
Okay, so let's talk about where the real opportunities are. I mean, you've unpacked a few of the examples. I mean, I'm talking, let's go into some asset classes. Buy to let, for example, affordable rentals. You mentioned student accommodation, multi-lets, where there's multiple occupancies in a property, short-term rentals. Where is actually the real traction that you're seeing versus the hype?
Well, recently I've been doing a little fun exercises with my son during a day with a beautiful rainbow and rainbows. And we were chasing the rainbow with a car just to show to him that there is no golden pot at the end of the rainbow. And we had a good laugh. So I think the asset class is a little bit like that. You can't just simply generalize, and it's very dangerous to generalize to say, well, this asset class, let's say multi-let or student accommodation, is better than traditional buy-to-let or short-term. That makes for a good story on the newspapers, but very rarely matches reality. I think what is quite clear is that there's been a lot of hype in the press and a lot of hype into investor circles and investors communities around certain type of investments, such as student accommodation, such as multi-let, where for a reason or the other, it was easy to see the upside without seeing the risks and the downsides. So there's been a period where traditional buy-to-let has been non-fancy or non-fashionable, and everybody also wanted to do. So I think what it boils down to is all these type of asset classes can be really good or can be really bad, depending on the quality of your execution when it comes to the investing process, and really coming down to the analysis of the specifics of that market, the execution of the property management life cycle from acquisition all the way to tenanting, all the way to retention, and the financial side. Because, for example, where a lot of call it student accommodation investors or speculators or get rich quick scheme type of guys have failed to understand is that you do need to have lots of cash reserves, because the likes of NEFSAs can be very erratic in terms of their payments, and go and tell the bank that you have been told by NEFSAs that you're going to be paid tomorrow and you don't, well, banks don't take it kindly. That's why banks themselves have tightened the lending on that type of investment now for quite some time, quietly behind the scenes, without necessarily making big announcements, because they've seen the type of risks they go with maybe the top line numbers. And investors should be very careful not to invest on top line numbers, but to invest on genuine, call it bottom line numbers, with a full consideration of the risk profile attached to it. So sometimes an 8% with no headaches can be a lot better than a 10% with a lot of headaches.
Okay, great. Thanks. So let's talk a little bit about, you mentioned the financing. So how are deals for investors getting funded in 2025? So talking this year, and let's look at bank appetite versus private alternative finance, because we've seen a lot of private lenders also come up, and definitely the likes of Tough and Business Partners and a couple of other financiers as well. And let's talk typical loan to value ranges, debt servicing coverage ratios. I mean, how many times cash flow should cover debt, and what actually makes a deal bankable today? Do you want to maybe just share with the audience?
Well, I think we have to differentiate between traditional residential lending and call it commercial property lending. And I think that, the specifics of my investment focus, the specifics of the support and the guidance that are offered to aspiring and growing property investors is mainly on the residential side. So as far as the residential lending side is concerned, well, 2025 is not fundamentally different than 2024 or different than 2023. There are very critical fundamentals around there that the average property investor in South Africa need to fully understand. Banks are very open to lending. They love property. They've continued to support property. And to a large extent, the fact that in South Africa we have 100% bonds on residential property investments is absolutely unbelievable. We love to complain about what is not working in South Africa, and surely there are a few things that are not working. But, many other countries in the world, which are supposed to be first world countries, certainly without a 20% deposit, you're not going to see any investment property under your belt. So I think let's, first of all, be grateful for the blessings of the South African financial institutions that are very much supportive. And ultimately, those institutions, when it comes to residential lending, they're more supportive of the individual rather than supportive of the property. And I think that's really important for everybody to be cognizant and really acutely aware that rather than the horse, they really love to support and sponsor the jockey, or maybe they call it the team owner. So critical that we protect our assets, our personal assets as investors, and that first asset is our credit score. Not only protecting it, monitoring it, managing it, looking how you can improve it. That can be improved very simply, very quickly, with fairly call it non-painful changes in the behavior of people. And it's quite fun. It always fascinates me how there are so many investors that get into the market without having a full, solid understanding of their access to credit. Because in some cases, people say, okay, there's a rule, you're making R1 million, and then you'll probably be able to access 3 to 4 million rand of lending in your name. That is not as simple as that. If you look at the specifics of the National Credit Act, and if you look at things like discretionary expensive, contractual obligations, so that level of understanding is important. But lastly, I would say 99% of property investors, including me, you should not try to deal with the banks directly. You should go through an intermediary Some people call it bond originators. I don't like the word, first of all, because they're not originating anything per se. It's really an advisor and an expert between you and the banks to make sure that you can express and communicate your circumstances, your objectives in the most professional way, because those policies and rules almost change overnight. The appetite can change overnight. So put yourself into the hands of an expert that can guide you, especially if you're trying to do it through juristic persons like companies, PTYs, trusts. So I think that's hopefully of value to your listeners and to the watchers of today's show.
Okay, so Carlo, if we, given what we said right now, can you maybe talk us through on the main principles of finding a good property deal? Maybe give the given the scenario of all the financing and all the different types of asset classes and the cycle. Maybe you take us through what
so
makes.
instead of trying to give you 10 commandments in a superficial way, let me just sort of try to deep dive on one, which based on my direct and indirect experience and looking into the future, I believe will be right at the top of defining whether you're going to make a good investment or a mediocre investment in property. And that is the choice of the area, the choice of the specific area you invest in. And because when you try to swim against the stream, you do a lot of hard work and you're not really making any progress. So you really want to be, I love cycling, and a lot of cyclists are property investors. You want to be in the slipstream of others. So you want to look into the slipstream of the specific area that you're looking at. And one element that a couple of let's say elements you want to look at. The first one is look at the solidity, the integrity of the local governance. Now, there are tools out there that allow you to monitor that local governance, but there's also simple ways for us as investors by walking around, by running around, by cycling around, by driving around to see, does this look like the kind of area that is well being taken care of? So that is number one. It has been number one for the last 10 years. And I really think it's going to continue to be the case for the next 10 years. And the other one is follow the big money. The big money opens the doors, and then the retail investors like you and I and many of your listeners will get into the slipstream. So look at the announcements of where the money is going and follow it. That's why I'm very scared when people say just invest in the Western Cape, because the Western Cape is a massive region with massively different realities, supply and demand. Within those, there will be winners and there will be losers. But certainly, you're probably better positioned than in the short term, looking at what is happening in other markets, which are battling the long-term effects of bad governance, of the big money flowing out rather than flowing in. So that's the key. So what I say is that I go macro. I want you to look macro before micro. A lot of people just look at running numbers by death of a spreadsheet. And that is a very dangerous way of approaching it. Because if your spreadsheet is great, but the roads around you are poor, your investment is unlikely to make you very wealthy.
Okay, great. So let's talk about a little bit about, let's say it's from chaos to cash flow, because it is chaos when you don't have cash, and property management. So, and let's talk about, the risk of tenants, how to do credit vetting, creating the right leases, deposits, and sometimes also evictions. So, Carlo, what are your non-negotiables on tenant vetting, lease structuring, deposits, and also handling arrears, so that you don't blow months of rent?
I'm gonna make you laugh, Neil. And my first not negotiable is that I fully expect to have problems. Okay, so and it's a much better mental approach, because if I fully expect to have problems, when they do happen, well, they happen like I expected it. And I think many property investors go in think it's going to be a perfect world and be disappointed when that's not the case. And as a result of that, they get very frustrated by the life of a property investor. So with that in mind, the first thing I then do on a practical basis is that I always want to have positive cash reserves to cater for those challenges. If I have a vacancy and I don't have the pressure of refilling that vacancy because I've got the cash reserves, I will be able to find the right tenant, even if the right tenant comes in week 6 rather than in week 1, because that is going to be the best investment on my property. So number one is I manage that from a cash flow perspective. And number two, I'm non-negotiable on the 21-day letter of demand. So if a payment doesn't come in by the 8th, I'm not trying to figure out the story of the life of this person. Automatically, that letter of demand has to be issued. While you're trying to understand the circumstances, get that in place. You are always going to be better off by issuing that letter rather than not issuing that letter. And to give you a third very practical action for all your investors to take, I'm not negotiable on a professional incoming and outgoing inspection. And I use the word professional in terms of the fact that as much as some letting agents offer their service, by nature, they either do it because they have to or they feel they have to, but they're not really properly geared or rarely properly geared to do so. So get a professional inspection service to come in to create a professional report that is co-signed by all the relevant parties. They really become a non-negotiable point of reference against which any damages and wear and tear can be duly assessed, not in a ego-driven basis, but on effect-based basis. And I think those are disciplines that are going to make your life, make my life, or as a property investor, a lot more relaxed and hassle-free.
Excellent. Okay, so let's add on to that. You mentioned obviously having cash flows available for for shortfalls and that kind of thing. So let's talk a little bit about value add plays that still work now. Subdivisions on properties, converting properties, and we're talking a cross-sectional title, multiple occupancy units, even student accommodation. And also light renovations. Solar's been a big thing as well, backup. So maybe let's talk about what criteria actually really moves rentals and valuations in an upwards direction.
Yeah, I think that's an excellent question, because in those markets where you're not necessarily having wind at your back, how do you create that wind in the back? And that's by creating value beyond just market attrition. And so value-added creations are particularly important and particularly available to the Gauteng investors, because Gauteng is often blessed with two things that the Western Cape is rarely blessed with. Number one is better weather. No, I'm just kidding. I'm in Gauteng, but I have lived in the Cape for 6 years. So it's blessed with more space to deal with, both in terms of the size of the dwelling and the size of the land. And you've got certain areas in Johannesburg where you can buy single family homes with on 1,000, 1,200, 1,500 square meters that allow for significant addition of bulk, significant addition either of sometimes one, sometimes two dwellings. And in a market, rental market, that remains very competitive, but in a rental market where call it single professionals, and I use the word professionals in inverted commas because when you use the word professional, you always think about accountant, lawyers, but I'm talking about like qualified nurses, qualified teachers, that type of cottage market, of a quality, safe, secure cottage market, has very solid demand with very solid cash flow. So a particular note for the Gauteng investors, look at what you do. But the second note is, don't do it the rough way. Do it the right way. Do it following proper zoning control, proper municipal processes, because down the line, if you want to sell the property, or maybe even better, you want to refinance the property, you don't have your paperwork in place, it's very likely you're going to have a problem, or you're going to have a loss of income, or a loss of growth. So rather do it slower, rather do it the expensive way, but eventually it's going to be more valuable. We also have incredible sectional titles. Look at an area like Parktown, which some of your listeners might know, where you've got traditional one bedrooms that are 100 to 110 to 120 square meters. Those lend themselves to subdivisions into 3-bedroom apartments. And again, there's a tremendous demand in an area like that, where you've got nurses. As you can see, I really like nurses as a tenant. Maybe junior professors at universities. Sometimes I'm calling non-NEFs as students, or just normal families. I use the word normal, like I am part of a normal family, hopefully.
We'll have to define that.
I know. Getting into a very dangerous space. So those are really tangible investment niche opportunities that ordinary investors like you and I can get into.
Okay, great. So let's talk about some of the biggest mistakes. I know you said right up front, obviously you're going to make a mistake. And so maybe just talk about some of those things that investors are making from a property investment. Let's keep one for novices, because certainly there are some more seasoned investors and those that are not seasoned, and those that are more portfolio proud, we could say, and who think growth, scale, and it equals success. So maybe share some of those.
So I'm gonna share with you two mistakes of mine in different phases of my career as a property investor, which luckily enough I found out to be not the only one. So that made me feel a little bit better. I think in terms of novice investors, as a novice investor, I would say one mistake that I have made is to look at investing where I knew the area, because I was either living there, working there, rather than just taking a much more well-rounded assessment of why should I invest in this area versus another area, which I might know specifically personally yet, but it represents a better investment area overall. And I think that's a mistake a lot of people make for various reasons. And careful, because this is a market that to a large extent, I think is not just even bipolar, because everybody's just referring Western Cape versus Gauteng. I think it's a market that is almost schizophrenic, because within certain areas, certain things are doing well and certain things are not doing well. So it's quite like a complicated market. Now, in terms of investors have already gone through a growth cycle, they mature. I would say one thing that I've often done as a mistake, which I'm getting better at, is getting rid of my past mistakes. Just because you bought something 10 years ago, and for a reason or the other, you are not as good as you are now. Now you don't have to hang on to that mistake. Just let it go. Every time I've let it go, I have made mistakes. I've invested almost in 100 properties myself directly in this country since 2003, and I'm not error-free. But when I've eventually let go, I've greatly benefited, at least from two ways. Number one is you are going to reduce your debt exposure, so improve your profile with the banks, but also your headspace, and your headspace is your biggest asset, is going to be more free, more available to grab the next opportunity rather than hanging on to a past mistake. So I think those are two realities of my life as an investor.
Great, I like that. So finally, Carlo, let's kill one myth that is holding investors back. Then share maybe one deal you do tomorrow at the drop of a hat. Give us maybe just a brief overview of numbers and why you would do that deal.
Yeah, I mean, urban myth or property myth. There's so many of them. It's almost like how can you only give me one to debunk?
Well, let's try one.
If you allow me, I'm gonna do two. I think the first one is that I hate is buy property and wait. You just, it's not about buying property and waiting, because in this market, if you buy in the wrong property in the wrong area, you're gonna wait a long time. You're gonna be becoming as gray as me, or maybe as gray as you. So I think that you can't just say investing in property is a guaranteed deal. I think anybody that says so is a liar. There's risk out there, and in an economy that hasn't grown 3%, 4%, since I was young and handsome, you really gotta choose the right property in the right area. I think the other thing from a lending perspective, from a funding perspective, because we touched upon that later, there is this urban legend that in order to borrow money for a property in a PTY, that PTY needs a trading history of 1 year, 2 years, 3 years, depending on which legend you follow. That is absolutely not true. You can absolutely borrow 80, 90, 100% of a property loan through a PTY that you've created a week earlier by registering the property on the CIPC website. You obviously need to work through the right people to help you in doing so, but that's very important debunking of the and I think in terms of what deal I would do, and I'm not saying that I would do this deal, but I want to give you a story, because I often find that investors confuse price with value. Now, I remember I've been in South Africa since 1999. And I remember around about 2000 sitting at a restaurant in Camps Bay. And you have all those estate agency windows there around about Camps Bay. And looking at one of these windows saying, and there was a house in Camps Bay that was going for 1.1 million rand. And I look at my friend who says, this is ridiculous. That this market is completely overpriced. Now that property will easily go for 12, 15 million today. So don't confuse price with value. You buy property for what that property is going to be in 10, 20, 30, 100 years time. And I would say that's the kind of deal that I would certainly consider again.
Carlo, that's a very powerful and practical discussion. Thank you for that. Just before we wrap up, where can our viewers start with the Property Coach assessment? Because I know you got an online assessment, and I know you also do workshops from time to time, or maybe just get some information. Where can they go to?
I would recommend that they go to thepropertycoach.co.za/events. And we have a number of both in-person and virtual events that can give them more access to the local and practical knowledge that I bring to successful, aspiring, and growing property investors that want to fast track their property success. Thank you, Neil.
No, thank you very much.
It's been an absolute pleasure to share with you.
Been wonderful. So if this helped everybody, subscribe to the channel, drop your questions in the comments, and you get our weekly investor newsletter, also our brief at rei.co.za. Thank you.